Kevin Warsh was confirmed as the 17th Federal Reserve Chair by a 54-45 Senate vote Wednesday, the narrowest partisan margin in Fed history. That alone should matter to Canadian investors. But the number that actually changes the calculus arrived one day earlier. U.S. headline CPI printed at 3.8%, above the 3.7% forecast, while wholesale PPI surged 6.0% annually, against an expected 4.9%. A new Fed chair inheriting accelerating inflation is not the same thing as a new Fed chair inheriting a rate-cutting mandate. Trump nominated Warsh precisely because markets read him as dovish, a signal that rate relief was coming after years of Powell-era caution. That reading is now under strain. Brent crude above $118 per barrel, driven by the effective closure of the Strait of Hormuz since the Iran conflict began, is feeding directly into shelter and transportation costs across the U.S. economy. Warsh publicly argued that AI productivity gains and balance sheet normalization could create room for cuts, but those arguments were constructed before jet fuel prices spiked 60% in a single week in March, before Karg Island, Iran's primary crude export terminal, went 4 straight days without loading a single tanker. The supply logic that underpinned his dovish framing has since inverted. The Fed chair is one vote on a 12-member committee, yet the chair sets the tone for forward guidance, and Warsh has already signaled he wants to de-emphasize that guidance. A Fed that speaks less clearly at a moment when inflation data is pulling in one direction and political pressure is pulling in the other does not reduce uncertainty, it reprices it. The Bank of Canada, which held its rate at 2.25% through April and explicitly kept hikes on the table, is now watching a southern neighbor whose monetary framework has become genuinely harder to model. The uncertainty feeding north across the border found a different kind of outlet in Canadian equity markets on Wednesday. Equinox Gold announced an all-stock acquisition of Orla mining in a deal valued at US $18.5 billion. The same day, Agnico Eagle formalized a $14 billion capital plan for its Ontario operations through 2030. Two of Canada's largest gold events landed on the same session when U.S. inflation data was flashing red. That is not coincidence in the positioning sense. It reflects a capital allocation thesis that has been building since gold hit record highs on safe haven and inflation flows. The Equinox-Orla combination creates a producer expected to generate 1.1 million ounces of gold annually, second in Canada only to Agnico, with an internally funded growth path to 1.9 million ounces. The deal was structured at market, no takeover premium, because Orla CEO Jason Simpson argued that scale itself was the value proposition. At current realized gold prices of roughly $4,800 per ounce, as Barrick's Q1 results confirmed last week, that math is compelling. Barrick simultaneously launched a $3 billion share buyback and announced a North American spin-off, a structure designed to attract investors who want pure play exposure to stable jurisdiction gold at a moment when African and Latin American assets carry geopolitical risk premiums. The counter-signal worth tracking. Equinox shares fell 1.9% on the day the deal was announced, even as gold miners broadly rallied. Markets are pricing execution risk, 6 operating mines across 4 countries, 2 management cultures, and a promise to double output over 4 years. Agnico's $14 billion, meanwhile, was clarified by the company itself as largely pre-disclosed capital expenditure, not net new investment. Ontario's One Project, One Process permitting reform was the real mechanism being announced, and permitting reform is a multi-year lag, not an immediate production signal. The gold thesis holds on price. The production ramp is the variable neither deal has yet proven out. The thread connecting Warsh's inflation inheritance to Canada's gold consolidation runs through the Strait of Hormuz, and specifically through what Trump carried to Beijing. The president arrived in China on Wednesday with satellite data confirming Karg Island, which handles the bulk of Iran's seaborne crude exports, had been silent for 4 consecutive days. Up to 90% of Iran's crude exports go to China, roughly 1.38 million barrels per day. A U.S. blockade that cuts Iran's primary export terminal does not just lift oil prices, it hands Trump a pressure instrument against Beijing at the exact moment he is asking China to expand purchases of American soybeans, beef, and aircraft. Copper hit a record US $6.69 per pound on the COMEX that same Wednesday. The mechanism is less obvious than an oil price spike. The Iran conflict choked sulfuric acid supply out of the Gulf, and approximately 1/5 of global copper production depends on sulfuric acid as a processing input. Analysts at Sprott estimate the Hormuz closure could directly impact 4.8 million tons of copper output. China's refined copper production already fell 3% in April as raw material shortages hit smelters. The result is a Canadian mining sector where gold consolidation and copper supply disruption are running simultaneously, both driven by the same underlying geopolitical event, but through entirely different transmission channels. The leaning here tilts toward continued pressure on Canadian rates and continued strength in precious and base metal equities, provided the Hormuz disruption does not resolve in the next 2 to 4 weeks. The Bank of Canada's own minutes noted that the situation could change quickly. The specific threshold to watch is whether Carg Island resumes loading before the June 4 Bank of Canada announcement. If loadings restart and crude retreats below 100, the inflation signal softens and rate expectations shift back toward cuts, which would lift the REITs and rate-sensitive Canadian equities that have been underperforming. If Carg stays dark and PPI continues running above 5%, Warsh faces a rate decision that contradicts the mandate Trump assumed he was installing. And that contradiction is what neither the bond market nor the gold market has fully priced yet. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.